Simplifying Elliott wave principle. The impulse phase. Believe it or not, it has actually been more than 60 years since the breakthrough discovery. R.N. Elliott, a shy genius near the end of his life, began to study price movements in the financial markets. He observed via the Dow Jones Index that certain patterns of human behavior repeat themselves, and with the few years he had left, Elliott offered proof of his discovery by making astonishingly accurate stock market forecasts. Clearly, these discoveries over time show their reliability, not only in the stock market, but also commodity, Forex, and bond markets. And the reason for this is that human behavior is almost identical in any market. Remember, all the technical teachings you're learning here can be applied to any market. Now that's a bonus. Elliott wave analysis is a collection of complex techniques. Approximately 60% of these techniques are clear and easy to use. The other 40% are very difficult to identify, especially for the beginner. The practical and conservative approach is to use the 60% that are clear. When the analysis is not clear, why not find another currency pair or commodity conforming to an Elliott wave pattern that is easier to identify? From years of fighting this battle, we have come up with the following practical approach to using Elliott wave principles in trading. Just remember, as we have taught that the markets trend around 30% of the time and range for the rest of the time, and of course, Elliott wave theory shines when prices are trending. But before we get going, always remember that in practice, the prices don't work precisely like the theory, just as with all other technical tools and theories we have taught you. That's why it's so important for us to highlight examples to you to show you just how you have to learn to adapt the essence of these theories into your day-to-day trading and not get bent out of shape when they are not precisely reflecting the theory. So now that we have all of that out of the way, let's see what Mr. Elliott is all about. The whole theory of Elliott wave can be classified into two parts. Number 1, impulse waves, and number 2, corrective waves.
Impulse waves. The impulse pattern consists of 5 waves. The waves can be in either direction, up or down. Because Elliott waves are heavily connected to the psychology of trading, it's essential we incorporate this into our teachings. But let's use a bullish move to do this. And the principle applies just the same to the bearish moves. Our prices start trending. The first wave is usually a weak rally with only a small percentage of traders participating. Once wave 1 is over, they sell the market on wave 2. The sell-off in wave 2 is very vicious. And wave 2 will finally end without making new lows, and the market will start to turn around for another rally. The initial stages of wave 3 are slow, and it finally takes it to the top of the previous rally, or the top of wave 1. At this time, there are a lot of stops above the top of wave 1. The traders are not convinced of the upward trend and are using this rally to add more shorts. For their analysis to be correct, the market should not take the top of the previous rally. Therefore, many stops are placed above the top of wave 1.
The wave 3 really picks up steam and takes the top of wave 1. As soon as the wave 1 high is exceeded, the stops are taken out. After taking the stops out, the wave 3 rally has caught the attention of traders. The next sequence of events are as follows. Traders who were initially long from the bottom finally have something to cheer about. They might even decide to add positions. The traders who were stopped out after being upset for a while decide the trend is up, and they decide to buy into the rally. All this sudden interest fuels the wave 3 rally. This is the time when the majority of the traders have decided that the trend is up. Finally, all the buying frenzy dies down. Wave 3 comes to a halt. Profit taking now begins to set in. Traders who were long from the lows decide to take profits. They have a good trade and start to protect profits. This causes a pullback in the prices that is called wave 4. Wave 2 was a vicious sell-off. Wave 4 is an orderly profit-taking decline. While profit-taking is in progress, the majority of traders are still convinced the trend is up. They were either late in getting in on this rally or they have been on the sideline. They consider this profit-taking decline an excellent place to buy in and get even. On the end of Wave 4, more buying sets in and the prices start to rally again. The Wave 5 rally lacks the huge enthusiasm and strength found in the Wave 3 rally. The Wave 5 advance is caused by a small group of traders.
Although the prices make a new high above the top of Wave 3, the rate of power or strength inside the Wave 5 advance is very small when compared to the Wave 3 advance. And finally, when this lackluster buying interest dies out, the market tops out and enters a new phase called the corrective phase or patterns, which we will investigate soon. Take a look at a real bullish Elliott wave example. But remember, Elliott waves also work in bearish, and we can see this in action here. There are 3 rules which we should hold true for an impulse wave if it is to be valid. Number 1, Wave 2 cannot move past the start of Wave 1. Number 2, Wave 3 cannot be the shortest wave of the 3 impulse waves. And number 3, Wave 4 cannot move past the end of Wave 1. If any of these rules are violated, you should try a different wave count. In some cases, the wave count can be considered valid if the currency prices violate any of the above rules, but not on a closing basis.
That is the simple essence of Elliott wave impulse phase, which is why, by the way, we refer to waves as impulse waves. But there is another type of phase called the corrective phase, which we will be taking a look at in the next presentation.